Money affects every part of your life, yet most people move through adulthood without ever understanding how it actually works. Taxes disappear from paychecks. Prices rise. Debt grows. And no one explains why. In this video, we're breaking down the basics of finance, how money flows, how systems like taxes, banks, interest, and inflation really work, and how these forces quietly shape your everyday decisions. Taxes. Let's set the scene. You've just wrapped up a brutal month at work. Long shifts, sore feet, the whole deal. You collapse into bed, and an email lands in your inbox. Your paycheck notification? $2,000 earned. But when you check your bank account, you're staring at $1,456. You scroll through the pay stub. Federal income tax, state tax, Social Security, Medicare. Welcome to the modern economy, where a portion of every paycheck quietly disappears before you even touch it. Here's the reality. Taxes are the financial foundation of a functioning society. Every dollar collected funds roads, schools, healthcare infrastructure, and emergency services, systems most of us rely on without a second thought. There are a few key types worth knowing. Income tax hits your earnings. Sales tax hits your spending. Capital gains tax hits the profit your investments make while you sleep. Then there's Social Security, a government-mandated retirement fund you contribute to now and draw from later. And Medicare, a health insurance program for the elderly and seriously ill. Filing your taxes? The government already has a rough idea of what you owe, yet still makes you calculate it yourself. Get it right, and you're fine. Get it wrong, and the consequences can be significant. The bottom line, taxes are non-negotiable, and countries with higher tax rates tend to report higher overall quality of life. The trade-off is worth understanding. Banks. You walk into a bank, hand over your cash, and walk out assuming it's sitting safely in a vault. The reality is quite different. Banks are not storage facilities. They are financial intermediaries, connecting people who have money with people who need it. The moment your deposit enters the system, the majority of it is already being lent out to someone else. This is fractional reserve banking. Banks only need to hold a fraction of total deposits in reserve, because under normal conditions, not everyone withdraws their full balance at the same time. The 2008 financial crisis was the exception, a wave of simultaneous withdrawals that exposed exactly how fragile that assumption can be. Banks make money by lending your deposits at a higher interest rate than they pay you. You're the supply. Borrowers are the demand. The bank profits from the gap between the two. In the US, your deposits are federally insured up to $250,000. So even if a bank fails, your money up to that threshold is protected. Interest. You borrow $1,000. When repayment comes, you owe $1,280. That extra $280 is interest, the cost of using money that isn't yours. Interest works both ways. When you borrow, it's the fee for accessing capital. When you save or invest, it's the reward for patience. Two types matter here. Simple interest is a flat, predictable charge on the original amount. Compound interest is far more powerful and far more dangerous. With compound interest, the interest itself begins earning interest. The balance doesn't just grow, it accelerates. Miss a payment on a 20% credit card, and suddenly interest is stacking on top of interest. A small purchase quietly ballooning into something much larger. But flip that same force into investing, and a 7% annual return multiplies not just your contributions, but the gains on those gains. Over decades, modest investments become serious wealth. The principle is simple. If you're paying interest, eliminate it fast. If you're earning it, let it run. Interest is either the engine of debt or the engine of wealth. The difference is entirely which side you're on. Inflation. You grab your usual bag of chips, same size, same brand, but the price is noticeably higher than last time. That's inflation doing its quiet work. Inflation is the gradual erosion of purchasing power. It doesn't announce itself. It simply means that over time, the same amount of money buys you less than it did before. What causes it? When demand surges and supply can't keep up, prices rise. When production costs increase, those costs get passed to the consumer. And when people expect prices to rise, they spend sooner, which drives prices up faster. A self-fulfilling cycle. Around 2% annually, inflation is healthy, a sign of a growing economy. But when it spikes, savings erode, wages lag, and financial planning becomes unstable. The government's main tool to fight it? Raising interest rates. More expensive borrowing means less spending, which cools demand, which brings prices back down. Recessions. A recession is a sustained economic contraction, lasting at least 2 consecutive quarters, roughly 6 months of declining output. In practice, it feels like this. One day everything is stable, jobs secure, bills paid, maybe a trip planned. Then things quietly shift. Postings dry up, layoffs begin. Spending drops, which cuts revenue, which drives more cuts. The feedback loop tightens. Triggers vary: high interest rates, global crises, or simply the natural economic cycle doing what it always does: expand, peak, contract, recover. The pattern is as old as capitalism itself. Recessions are painful but temporary. Governments lower rates, deploy stimulus, and encourage spending. Confidence slowly returns. Growth resumes. But the experience tends to leave a lasting mark on how an entire generation handles money. Credit scores. Your credit score is a 3-digit number with an outsized role in your financial life. It determines whether you can get a mortgage, lease a car, or access reasonable loan terms, or whether you pay punishing interest rates that cost you thousands more over time. It's not a measure of wealth. It's a measure of trustworthiness. Lenders want to know one thing: will this person pay me back? Scores run from 300 to 850. Below 580, lenders see risk. Above 750, most doors open. The majority of people sit somewhere in between. Your score is built from payment history, the most important factor, plus credit utilization, account age, credit mix, and recent inquiries. The formula is straightforward: pay on time, every time, and keep your balances manageable. One counterintuitive catch: you can be completely debt-free and still have a poor score, simply because you have no credit history. The system rewards demonstrated behavior, not just good intentions. Learn the rules, and you can work them in your favor. Currency. Here's something worth sitting with. Money isn't really real, not in any intrinsic sense. It's a collective agreement. Humans developed currency to make trade efficient and society easier to organize. Before money, you needed to find someone who had what you wanted and wanted what you had. Money eliminated that problem. But the legitimacy of any currency is entirely built on shared belief. A dollar has value because society agrees it does. A cryptocurrency has value because its users agree it does. A stick has no monetary value because nobody agreed it should. The only difference between a dollar bill and a piece of paper is the story we've collectively decided to tell about it. Governments authorize money's creation. Central banks regulate its supply. Too much printed and inflation erodes its value. Too little and economic activity stalls. Currency is a social technology, and it works for as long as people believe it does. Investing money. Sitting idle loses value over time. Inflation guarantees it. The most reliable counteraction is investing. Investing means deploying your money toward assets with the potential to grow, putting your money to work rather than waiting for your next paycheck. The main options. Stocks give you fractional ownership in companies. When they grow, your stake grows. Bonds are loans to governments or corporations, repaid with interest. Funds bundle stocks and bonds together, spreading your risk across many assets. Real estate generates income through rent or long-term appreciation. Successful investing isn't about perfect timing or lucky picks. It's about starting early, staying diversified, and maintaining patience through the inevitable ups and downs. The real danger isn't a market dip. It's never starting and letting inflation quietly drain your future. Value is the most fundamental concept in finance, and one of the most overlooked. Pick up a rock. Ordinary, Unremarkable. Now imagine it's gold, rare, lustrous, historically coveted. Gold isn't inherently more useful than a common rock. But we've collectively agreed it's worth more, and that agreement makes it so. This scales to everything. Steve Jobs built enormous wealth not through luck, but by creating something millions of people found so valuable they paid a premium for it, repeatedly. Surgeons and attorneys earn high compensation because the value of their expertise, in outcomes, in risk, in life-changing decisions, is real and large. The same principle explains why a luxury handbag can cost 100 times more than an identical-looking one from a budget store. It's not the materials, it's the perception. In economics, perceived value is real value. If you can consistently deliver something others find valuable, a product, a skill, a service, an experience, you've found the engine of sustainable financial success. Time of everything covered in this video, time is the most finite asset you have and the most powerful. Most people trade time directly for money. 1 hour worked, 1 paycheck earned. It's the default model. But the highest earners have learned to break that equation, building systems, investments, and leverage that generate value beyond the hours they personally work. Nowhere is this clearer than in investing. Compound growth over long time horizons is one of the most powerful forces in personal finance. Money invested consistently doesn't just grow, it multiplies. Slowly at first, then with accelerating force as compounding takes hold. This is why ordinary people with modest incomes can retire with significant wealth. Not because they earned extraordinary amounts, not because they timed the market perfectly, but because they started early and let time do its work. The most important financial decision you'll ever make isn't which asset to buy. It's deciding to start, early, consistently, and with patience. A small amount of money invested deliberately, given enough time, becomes a large amount of money. That's not a theory, that's mathematics, and it's available to anyone willing to begin.